Okay, ladies and gentlemen, time for another exciting episode of Stacking Adventures. Today is Monday, January 1st, the new year, 2024. This is Season 8, Episode 1, and the subject is the 2023 investment returns. But first, I just want to take a look at some coins here that I picked up this year. So there it is. I got these in change. It's a €2 coin. You can see it's got a map of Europe. There's the Iberian Peninsula and Great Britain, Ireland, Norway, Sweden, and the rest of Europe. And if I flip this thing over, there's the other side was the this is the front side. The other side was the reverse side. And this, I think, is a generic coin. It's a 2017. But just let me show you a couple of others that I picked up over the year. So here's one, 2019. It says Bundesrat D. So the D indicates that it's Deutschland, which is Germany. And the Bundesrat, Bundes means like national, rat is like the city hall or something. So it's like the National Congress or something like that. And let's look at another one here that I found. Okay, there's another good one. This one says 50-yarder Kniefahler. 50-yarder Kniefahler in Von Warschau. And what this was, it's a 2020 A. And this is a anniversary of in 1970, Willy Brandt took a knee at the Warsaw Uprising monument. So this is the 50th anniversary of him doing that. And let's take a look at another one here. This is this one says RI. You can see there on the left side there. And RI stands for Repubblica Italiana. Repubblica Italiana. So this is an Italian coin. And it's a 2022, and the head you see in there is the famous poet Dante. So every country that has the euro can have a national coin. So this was their national coin in 2022. They also have commemorative coins. And here's another coin here, and this is says Brandenburg D. It's a 2020, and this is the Palace of. I forget how you pronounce it, Sanssouci Palace in Brandenburg, the state of Brandenburg, Germany. So that's that one. And I got one more here to show you. That's this one here. It's a 2016. It says Letzeburg. And in case you don't know, Letzeburg means means Luxembourg in Luxembourgish. So that's some of the coins we picked up this year. Okay, let's get started with the presentation. So here's the executive summary for the 2023 investment returns. I've got 5 bullet items. The first item is that interest rates continue to rise in 2023. And I'll just show this chart here. This is the federal funds rate. You can see the federal funds rate was 0 in 2020 and 21. And about February, they started raising the rates, and they get up to they raised all through 2022, and they finished in August of 2023. They got up to above 5%. So what happened was, in 2023, you can get 5% CDs, which a lot of people are cheering, and you also got 5% in your money market fund, and the TIPS real yield was 2% in 2023. In fact, in October, the TIPS yield actually get to 2.5%. The second bullet item is that disinflation. The inflation rate was slowing down. If you remember in 2021-22, it was like 7 and 6%. And now, or this year, they were like 3.4%. So they're declaring victory. They're saying they have inflation whipped and expect rate cuts in 2024. Well, guess what? These rate cuts are expected now. They caused us to melt up in the market at the end of 2023. The stock market went up like, a whole bunch. And you ended up with with the stocks returned about 25% this year for U.S. stocks, and the international stocks returned about 15%. And the bonds didn't do quite as well. They're actually negative for a lot of the year because the interest rates are at high levels. But again, the interest rates came down at the very end of the year a little bit, not a whole lot, just a little bit. And so bonds have single-digit bond returns. So the bottom line is that people's stock bond portfolios, they got somewhere between like 5 and 15% return. Now I just want to show you here the way I rate the investments. I grade them with a letter grade, where C is the average, and the average means like get between 0 and 10%. So for instance, if you have a 5% CD, you're a solid average. And of course, B and A are above average, and D and F are below average. And just look really quickly at the currency stability. CPIU, it ended 2023 at 296.797, and the number in November was 307.051. So that was a 3.45% change in CPI. So they, like I said, they claim they have the inflation is whipped, and they're going to start cutting rates in 2024. As far as the euro versus the dollar, at the end of 2022, a euro was $1.07. At the end of 2023, it was $1.10. So about a 0.5% change in the price of the euro. And the same thing with the dollar index. It was 103.49 at the end of 2022, 101.38 end of 2023, about 0.5% change. And what I'm going to do this year, I'm not going to look at this year, but I'm going to look at the last 4 years just to see the trend. And so CPIU, you can see here, back in 2020, inflation was 1.4%. And before 2020, it had been under 2% for many years. And then in 2021, it was 7%, in 2022, it was 6.5%, and in 2023, about 3.45%. So you can see they think it's going down, so that's where they're cutting inflation. They're cutting the federal funds rate. Okay, now we're going to look at the major asset classes, which is stocks, gold, bonds, and cash. And basically, it was a pretty good year for investors. The stock market returned about 21%. That's the world stock market. Gold did pretty good, got 13% return. Bonds, not quite as good, but not so bad. They were single-digit returns, 5% for the U.S. and 8% for the international. And finally, money market funds returned 5%. And again, I'm going to look at over 4 years here. You can see that things aren't quite as rosy as they appear, right? Even though the stock market went up 21%, well, guess what? Last year, it lost 18%. So you're really kind of just about breaking even over the last 2 years. And it looks at the bottom, you can see the money market fund. Back in 2020, it was only making like 0.5% interest. And in 2021, it was even worse. It got basically 0 interest. But then they started raising rates. In 2022, got 1.55, and in 2023, got 5%. So hopefully in 2024, they don't cut rates too quickly. Maybe we'll end up getting about 4% this year. Now I want to look at the precious metals here. I'm only going to look at gold and silver. Gold basically did pretty well, made up at the end of the year, it kind of zoomed up above 2,000. And they got a 13% return. And by the way, I'm looking here at the gold ETFs, gold and silver ETFs, because it's much easier to trade those if you're investing than physical gold. So gold got a solid C. Unfortunately, silver, the price of silver shares went down 1.09%. So, silver investors, the silver stackers didn't really do that great. Now, Bitcoin, on the other hand, had a tremendous run. It went up. It ended 2022 at about 16,000 and ended 2023 about 42,000. Right? That's insane. It went up 155%. It like tripled in value. So I give it an A++++. Now the only thing is, again, this could be very misleading when we look at over the multiple year period. Because if you notice here, Bitcoin, even though it went up 155% this year, Well, last year it went down 64%. Of course, you know, if you go down 50%, you have to go up 100% to break even. So basically, Bitcoin is just basically back to where it was, at the end of 2021. So over the last 2 years, it really hasn't made any money. It just went way down, and then it went way up. Gold is, like I said, it's not doing too bad, although in 2021 22 it lost money. So it did okay this year. Silver, not so good. Okay, now we're looking at the main investment that people invest in, which is stocks. And I've basically compared U.S. versus international here. And just to cut to the chase, the big story is U.S. beat international. U.S. had about 26% return. International had about 15% return. And now you notice international had more of its return come from income, which is dividends, and had less come from the price change. Whereas the U.S. stock market only had about 2% come from income, and the rest come from the price change. But let's look at over the last 4 years. You can see it's not really quite as rosy as it appears. Even though you made 26% if you invested in the S&P 500 or total U.S. stock market, well, guess what? Last year, you lost like 18% or 19% in the total stock market. So you're kind of just about back to even where you were over 2 years ago. So like I said, if you look at over a multi-year period, you'll see things aren't always sometimes as good as they appear. And here I break down the U.S. stocks, value versus growth, large versus small. And just to cut to the chase here, value lost to growth. I mean, growth beat value by like a huge margin. Growth was up 46%. Value was only up 9%. And just a huge story there. And also large cap beat small cap. But look again, let's look over the multi-year period. And well, you can see they're actually positive every year here. So last year the value made a little bit of money, the growth made a little bit of money, they all made a little bit of money. And so that's the 4-year period. And now we're going to look at the international stocks, developed versus international. Again, just cut to the chase. The developed beat the emerging markets. 17% for the developed, 9% for the emerging markets. And emerging markets are supposed to do better when the stock market does well. They're riskier, but they're supposed to do better. But here you get the developed markets did a whole lot better than the emerging markets. And comparing European versus Pacific stocks, 19% versus 15%. So European stocks won. And by the way, Pacific is mostly Japan. A big chunk of it's Japan. And here it is over the multi-year period. Again, it's not quite as rosy as it looks. People are just kind of getting back in 2023 what they lost in 2022. So, in fact, if you look at the emerging markets, lost 20% in 2022, only gained 9% in 2023. So it hasn't even broken even over the 2 years. And here's some people like to invest in high dividend stocks. So we compare the high dividend versus dividend growth stocks for both U.S. and international. And it turns out this year, if I compare the U.S. high dividend only made 6% this year, not too bad. About 3% of that came from dividends, and 3% came from the price increase. So it hasn't gone up a whole lot in price. And meanwhile, the dividend appreciation index, which is dividend growth, that returned 14%. Only 2% was from dividends, but 12% was from the price increase. Now, as far as the international dividend stocks, they did a lot better. They actually returned 16%, and the dividend appreciation returned also about 16%. Now we turn to, okay, here's the 4-year chart, and I won't make any comments about that, but so now we move on to some sectors where we compare consumer staples versus consumer discretionary and a few other sectors. It turns out that the consumer discretionary just totally crushed the consumer staples. 40% return for the consumer discretionary, only 2.3% return for consumer staples. In fact, consumer staples had about a 2.69% dividend return, and the price actually went down a little bit, about 0.3%. It was down. So another one that had the price was down was the utilities index. The utilities index actually is the one negative here, I think, in my entire chart. Minus 7.46% total return for the year, had about 3% dividend return, but the price went down 10.6%. So maybe there's some bargains there in the utility fund. Another one that did really good is at the bottom there, the communication services, VOX. Total return 44%, has very little return from dividends, so the price just went up like 43%. So pretty incredible. But again, it could be very misleading because let's just take a look at the previous year, the previous 4 years. Here is the last 4 years, and you notice that at the bottom there, in 2022, the communication services lost 38%, and this year they gained 44%. So they really haven't even broken even. So over 2 years, you're basically still behind. And it's a similar story for consumer discretionary. Even though they were up 40% this year, last year they lost 35%. So you kind of just, basically getting back to where you were at the end of 2021. So kind of misleading to think that this was a great year for stocks because it was really not. It was a really mediocre 2 years. And we'll move on here just to the last group of sector stocks. And this is real estate. We have U.S. real estate and global real estate. They did okay, 11%, 6%. We also have the energy fund here, did 8%, and the healthcare fund did 5%. But again, if we look over the 4 year period, not quite as good as it appears. So even though you got 11% this year, sounds good. Well, last year you lost 26% in U.S. real estate. So, with 2 years, you're basically underwater still. You're still way behind. And the global real estate's even worse. They lost 22%. They only made 6% this year. Way underwater in real estate. The energy fund, though, did good again this year. Last year, it was the only one that made money. So, anyway, that's it for the stocks. Okay, so now we're going to turn our attention to the fixed income market. And we'll just put this chart up again here. And this is basically what drove the fixed income market all through this year for 2023, last year. And this chart goes back to January 2019 when the federal funds rate was above 2%. It was about like 2.25%, 2.5%. And then in 2020, when they had the pandemic, there was a recession. They lowered, that's the gray bar, they lowered the interest rates all the way down to zero. And they held them at zero all throughout 2020 and 2021. They finally started raising rates in about February 2022. They raised the rates all the way through 2022 and 2023 up until about August when they got a little over 5%, about 5.25%. So that's when they end up with CDs yielding 5% and the money market funds yielding 5%. So first we'll look at the treasuries. And the top line there is the money market fund, and it made about 5.5%, 5.05%. Meanwhile, the short, intermediate, and long term made 3, 4, and 3%. So they had single-digit returns. Not that great, not that bad. It's kind of a low C. But let's look at it over a 4 year period. And you can see here, it's actually a lot worse than it looks because making 3, 4, and 3% in 2023 has not made up for losing -4, -10, and -29 in 2022, and -0.8, -2.8, and -5 in 2021. So for the last 3 years, Treasury bonds are terrible. You were behind. You've lost a bunch of money. That money is probably I'm not sure when it's going to come back. Okay, next we look at the longer term treasuries. These is EDV is the long-term strips, plus the TIPS, which is the inflation bonds, and the mortgage bonds, Ginnie Mae. And the EDV made 2% last year, TIPS made 3.6%, and Ginnie Mae fund made 5%. But again, if we look over the 4-year period, things are not that rosy at all. You know, making up 2% in 2023 does not make up for losing 39% in 2022 and 6.5% in 2021. You are so far underwater with these long-term treasuries that it's not even funny. And unlike stocks, they don't come back. They basically just kind of languish. The TIPS, people would think that, oh, you should have done pretty well because there was high inflation. Well, guess what? The interest rates went up in 2022, the real interest rates, so we ended up having losses in the TIPS. So, and again, the 3.65% return in the TIPS in 2023 does not make up for the 12% loss, the minus 12% loss in 2022. And same thing's true for the Ginnie Mae fund, which is mortgage bonds. 5% return this year does not make up for the 10.8% return in 2022 and a minus 1% return in 2021. So yeah, over the last couple of years, these bonds also did terrible. Now, what about the municipal bonds? Now, if you have a taxable account, a lot of people who pay a lot of taxes will have municipal bonds. And the top line is the municipal money market fund, made 3.25%. Again, that's state tax free if you have to pay state taxes. The short, intermediate, and long term made 3, 5, and 7%, a little bit better than the treasuries. And the high yield, which is kind of the junkier ones, made 8%. Now, it may sound really great. Oh, I wish I was in the 8% high yield one there. However, if we go look at the 4-year return, things aren't as rosy as they appear. Even though you made 8% in 2023, you lost 11% in 2022, so you're still underwater. Same thing with the short, intermediate, and long term. You basically 3, 5, and 7% return, but you lost minus 0.8, minus 6, and minus 10%. So last 2 years, the bonds have not been doing good at all. And now we look at finally the corporates. And again, we got to just do the short, intermediate, long, and junk corporates. They return 6, 8, 10, and 11%. Not too shabby, you would say. But again, if we go and look at the 4-year return here, you're not doing too good, right? They've lost money for the most part over the last 3 years. You know, in 2021, they lost money. In 2022, they lost a lot of money. And then the return you got this year, you're not even close to breaking even on these bonds. So for the last 3 years, these bond funds are just doing terrible. Okay, now we finally get to the more realistic part of the presentation where we looked at balanced funds, because those were just all individual asset returns, but this is actually what people invest in, mixtures of stocks and bonds. So this is the balanced funds, and the top line is the balanced index of 60/40. We got Wellesley Income, we got the Wellington Fund, we got both U.S. Wellesley and Global Wellesley, U.S. Wellington, Global Wellington. Well, the returns you can see, they were like anywhere from like 7 to 17%. If you had the 60/40 at the top there, you got 17.58%. If you're in Wellesley Income in the U.S., you got 6.9%. If you had a little more stock, which is what Wellington does, you got 14%. And again, if we look at it over the 4-year period, things aren't as rosy as they appear. You know, you made 17% in the balanced index. Last year, you lost 17%. So you're basically just close to breaking even. The Wellesley, last year, it lost 9%. This year, it gained 7%. So you're still behind. Wellington made 14% this year, lost 14% last year. you're basically about breaking even. So the last 2 years, you basically just, you're about even. This year's great returns is just making up for the terrible returns last year. So we'll see what happens in 2024. But now we're going to turn to the really interesting part, and this is the lazy portfolios. Remember the lazy portfolios? These are portfolios from experts. They're simple portfolios. You don't have to do any work. You just basically buy these things, and maybe you have to rebalance them every once a year or something. But these people write popular investing books. So we'll just kind of go over the list here. Enter to Bias, 16%. Bill Bernstein, 11%. Coffee House, 11.6%. The Bogleheads, 3 Fund, 18%. David Swenson, 14%. DFA Retirement Income, 7%. The Larry Swedrow Larry Portfolio, about 7%. The Ivy Portfolio from Bain Faber, 10.7%. Scott Burns Couch Potato, 14.6%. The Warren Buffett Portfolio, 24%. And the Harry Brown Portfolio got 11.5%. I also throw in here Berkshire Hathaway stock, got about 15%. So you can see if I go back to the front one here, they're all like in double digits, 11. Well, a couple of them are only 7. So anywhere from 7 to 17%, something like that, except for the Warren Buffett, which is 90% stocks, got 24%. But again, we'll just look over the 4-year period here. Not as quite as rosy as it seems. Again, basically, the theme in 2023 is you clawing back the losses of 2022. 2022 was, you had huge losses, double-digit losses for these lazy portfolios. This year, you're basically kind of clawing it back. In some cases, you may be even. In some places, you're probably not even. You're probably a little bit behind. And here's like the last one here. So that's the lazy portfolios. So that is the investment returns for 2023.